So let me kick this off. We have I'm sure this is going to climb as we go, but I appreciate those. There's 20. That was our magic number, and we'll see this kind of increase. So first of all, thank you so much for everyone that tuned in and saw us post, or you got an update from C2 Ventures or our friends at Propeller. Super grateful that you guys could join us on a really important and timely conversation. My name's Chris Cunningham, managing partner at C2 Ventures, an early stage venture firm here in New York. We do pre-seed and seed investments, early stage companies. We were also all primed to have a story summit in April to bring founders together to talk about very relevant and important topics that are relevant in both a pre-pandemic and a pandemic world. That got canceled for obvious reasons. As a result of that, when we were all quarantined, we started thinking about ways that we could continue to formulate a conversation and dialogue. And we came up with the idea of lessons from lockdown. And lessons from lockdown was really the idea of bringing thought leaders and great companies like Propeller together and founders to keep that dialogue going in obviously a digital world. So we've done one of these before. We'll do many more. C2 Ventures is really here to sort of bring the platform and the stage with the great partners like Propeller. So that's our involvement. Many of you that come from the founder ecosystem or some of the existing Propeller customers and clients on the call are well aware of Propeller. I'm going to pass it to Anthony in a minute. Obviously a strategic and financing accounting partner for venture stage companies, focused on the financial lens, which is critical. The topic today is balancing growth and runway in uncertain times, which obviously we are in. We have two main hosts today, the CFO of Propeller, Anthony Rosen, which I'll introduce him properly in a minute. The CEO, Chris Fenster, is someone I've known for a long time, and my partner, Matt Olivo, at C2 Ventures. So they're going to be leading the discussion. We really, really want to have as much Q&A and opportunities for all of you guys to ask your questions, whether that's in the chat, which I'll be responsible for identifying. Anthony and Matt will take pauses in between the session to allow for questions. So we really want participation. Anthony's going to take you through and set the stage for everyone and sort of the context of what we think is important to talk about, such as balancing growth and runway, maximizing capital efficiency, and obviously how founders and startups are thinking about current events. So that's to set the stage. I think the housekeeping is really, we hope that you can stay on as long as possible. We're going to take this to at least 4 o'clock Eastern. And again, just want as much participation as possible. So thanks again for joining, and I'm going to pass it over to Anthony.
Thanks, Chris. Happy to be here and share my lessons from lockdown. As Chris said, I'm a CFO here at Propeller. Been here about 2.5 years. Propeller works with about 300 or so venture stage companies. And I've got 30 or 40 in my portfolio focused on direct to consumer. So the lockdown over the last 3 to 4 months has certainly been a roller coaster as I sort of think about it. It's sort of been a few different phases. I think, the first phase, late March and early April, was all about sort of crisis mode, applying for PPP, really trying to cut costs as much as possible. And then we sort of, especially in direct to consumer, saw a really nice bounce. And I think April, May, early June has been amazing for a lot of direct consumer brands. And I think we're now sort of approaching sort of a new normal and a new steady state. And I think, what I'm talking to my clients about now, and I think what people are focused on, what I want to talk about in these slides is really a couple of things. One is sort of the fundraising environment and what does that look like today? After being closed for a while, sort of, what's out there and what does the fundraising landscape look like? And then, how are people thinking about growth versus profitability? I think that's a shift that was probably already happening pre-COVID, but especially post-COVID, it's something every sort of founder and CFO needs to think about when they think about their projections. So, as Chris said, I got a couple of slides on that. Happy to answer questions as we go, and I'll go from there. So I think to start, I just want to sort of step back and think about the big picture of the fundraising landscape today. I think, in April and May, it was pretty much closed and pretty frozen, except for sort of extreme circumstances where companies were putting in getting bridge rounds. But what I've seen in the last month is it's really, really opening up. I've got a handful of clients that have closed rounds in the last 30 days, another handful that have sort of signed term sheets and are in the middle of diligence. And so deals are happening. There's definitely more of a shift towards existing investors and bridge rounds. But that being said, there's also sort of new firms coming in and making investments. There's a lot of funds that still have capital that they need to deploy. And so deals are happening again. I think, not surprisingly, valuations are coming under pressure. And I think investors are realizing that they may have the upper hand, depending on the company that they're talking to, but they are putting pressure on valuations and multiples. So, what those were pre-COVID may not be the same post-COVID. And some of the advice that I'm giving to my clients to help them get through this is sort of, for one, making sure they're communicating, really openly with their existing investors, and making sure that people, their investors know where they stand. Thinking about convertible notes, that's certainly sort of a tool that's quicker and it's easier to do than rounds. And, I think one of the big changes that I've seen come out of this in the last month or so is, one of the things I had to do with all my clients in the last 60 days is totally redo their not just their 2020 forecast, but sort of their forecast beyond. And I think, we're going to talk later about the shift from growth to profitability. And I think investors are really, focused on that and really wanting to see companies being more capital efficient. And I think, the days of being able to show, $10 million cash burn are sort of gone. And I think in order to raise money, I've pretty much redone the 2021 forecast for almost all of my clients to try and show greater capital efficiency, a longer cash runway, and sort of demonstrate to investors that, these companies are more longer term viable. And I think, again, we'll talk about that in some later slides, but I think that's something that I've sort of done with most of my clients as they're going out to fundraise. And then when we think about sort of the different people investing today, right? I sort of put it in three buckets. You have sort of the angels and the high net worth folks. You have financial institutions, then you have strategics. Definitely seeing sort of a lean towards the financial institutions. Most of the investments that I've seen over the last 30 days and that are sort of happening now are coming from that space, from the funds. I think certainly there's some angels out there that are still going to be investing, but a lot of those folks are sort of pausing and are a little more risk averse. And I think when you look at strategics, they're also a little bit more risk averse. They've got their own sort of operational issues that they're dealing with, obviously, with their company. And while they may have capital to deploy, they're probably going to be more conservative in doing so. That being said, I just read the deal this morning with Lululemon acquiring Mirror. So there's certainly strategics out there looking to do deals for the right company, and that was a great exit and a great great deal for probably both sides. But that being said, the majority of the deals that I'm seeing right now are coming from VCs who, again, have the capital to deploy, and they do have to deploy it, but they're being a little bit more picky and choosy, looking for bargains, and just being a little bit more probably price sensitive. Some of the challenges that I think of, when I look at sort of the fundraising environment today and the challenges that people are facing is sort of the noise out there. So what's happened over the last 3 to 6 months is not the norm, right? You've had some companies that have gone to zero revenue, and you've had other companies where they've seen massive boosts. So I think the challenge for both companies and investors is figuring out what's the new norm and what's the right forecast. So I think that's again one thing that companies are going to have to sort of figure out when they're sort of putting together their forecasts, and investors are going to have to figure out what they're comfortable paying for, and what multiples they're going to apply. I think really understanding as well as good as possible what the cash runway of the company is important for the company, and understanding sort of when they need to go out and raise and what their timing is, and also for investors, so they know when they're putting in capital, how much do they need to put in, how long is that going to last, How long is that going to take me until my next round? So there's just some challenges that sometimes some of these are faced sort of in a normal environment, but are sort of exacerbated in a COVID environment when investors are particularly focused on risk mitigation and making sure that their companies are going to have the runway that they need to survive.
Yeah, Anthony, I just add to that quickly that what we've seen with some of our portfolio companies who had sort of were in the process of raising pre-planned rounds coming in or around the crisis is that that reduced risk appetite. It really, even if it's subconscious, it gives venture firms and others just more. They're almost looking for more reasons to say no to a deal, which is going to make it, you touched on this earlier, but it's going to make it a lot harder for someone who's brand new to the company to convince them to invest at this point in time, regardless of how good the performance is. That plus the continuing compression of valuations, what we've seen a lot of folks do, which I think is kind of the only solution there, is to potentially reduce the round size that you had targeted to something more of a kind of a bridge and try and plan for a shorter time. Think of this as a smaller round that gets you, a bit further along, but not as far along as originally planned, with the idea of then going back out again for that bigger round later.
Yeah, I'm definitely seeing a lot of that. I've got, companies that in a normal, pre-COVID world would have been looking to raise 3 to 5 million that are now figuring out what's the absolute minimum that I need to get through end of 2021. So what's going to give me 12 to 18 months of runway? Can I get by with 1.5 or 2? And how can I put that together from a mix of existing investors and new investors? So definitely seeing that. I think the other, last point I'll make on this is the challenge of sort of when I talked about noise and figuring out multiples, is there's also a lot of companies that have shifted their business model from sort of maybe wholesale to direct to consumer. And so how are those companies going to be valued? That, they've had 3 amazingly strong months of direct to consumer, which is something totally new to them. And, any investor coming in is going to be like, how sustainable is that? So being able to sort of convince potential investors that is, your new business model and that it's sustainable is going to be important.
Yep.
So I think, again, I touched on this earlier, but I think the big thing that, I'm talking to all of my clients, and when I did the reforecasting for all of them, it's all about these sort of competing priorities or competing forces of growth and profitability or runway. And there's not, what I tell them is there's not necessarily one right answer, depending on sort of where you are, where you are at a stage and what your priorities are. It's sort of a spectrum, which we'll see on the next slide. But there's certainly been a shift towards, profitability being more important at an earlier stage. I think, traditionally companies that were pre-seed, seed, Series A, and maybe even Series B were all about the growth. And it was more, sort of Series B and beyond, whereas about profitability. But now, even my clients that are Series A, pre-Series A, or just seed round, have to be able to show that in 2021, they're, maybe not throwing out 20% EBITDA, but they're at least break even. So I think, the stage that the company's at is certainly a big factor. And then sort of thinking about sort of the other sort of things on that spectrum are, how much capital are you going to need, right? If you're going for that growth and really targeting growth, you're going to need to raise a lot more capital. That's going to lead to dilution, and that's going to lead to, what we like to call preferred overhang, which basically means there's, way more preferred capital sitting above you on the cap table. So that's going to impact, what your exit strategy is, what, multiples you're going to need to hit to get sort of a big valuation at the end and exit and make, give everyone a good return. I've got a couple of example cap tables that I'll show after this, but as you focus more and more on growth, that's going to become more of an issue. Whereas if you're focused more on profitability, less capital intensive, lower dilution, potentially you're going to exit at a multiple that's based on EBITDA and not necessarily just revenue. And there's going to be a lot more sort of potential room for future growth. So if you're sort of growing more conservatively and really focused on profitability, whoever's going to come in and acquire you afterwards there may be a lot more headroom for that person to sort of expand into further distribution channels or new product launches. So is another sort of consideration to think about.
Hey, Anthony, Chris here. Just a question I got from one of our guests, Morgan, that was tied to a point you made earlier. Question is around revenue-backed debt as an alternative for those that are afraid of dilution. Do you have any thoughts around that, or Chris or Matt?
Yeah, I think I literally on one of my slides, I think future slides, I talk about exploring different financing options. And I think people definitely need to be creative and open to exploring different things. So that could be, debt backed by inventory or working capital, exploring new things, talking to folks like Clearbank who are, focused on your marketing spend, or just as simple as like going to Brex and expanding your credit limits. But there's definitely, other creative ways to sort of extend your runway and capital, negotiating payment terms with suppliers, all of that stuff. Definitely highly recommend to folks to look at before they necessarily go out and raise a priced round that is diluted.
Yeah, and I Anthony, on that point too, I actually, at least for the, some of the term sheets I've seen for some portfolio companies who are looking at that revenue-backed financing option, I actually think it's a really good one. You get the advantages that you get with debt in terms of non-dilution, right? And if you look at implied interest rates, I mean, they can be pretty high, but the cost of equity is massively high for an early stage startup. So it's always going to be still cheaper than equity. And the nice thing about it, relative to more traditional debt is there's less kind of default risk there, because you are paying as a percent of revenue versus kind of a fixed amount that you're
exactly
that you're going to be stuck with. So you kind of reduce that risk as well. So yeah, I do think, I mean, again, every provider and set of terms will be different, but from what I've seen, I think it's a pretty good option.
Yeah, I mean, I've got a bunch of clients that have taken loans from Shopify, for example, and again, it's not super cheap. It may be 10 to 15%, but again, as you said, Matt, it's much cheaper than equity, and it can be a good sort of bridge, over 3 to 6 months to sort of get you over the hump.
Yeah.
The other thing that I would add to that is that there's an optimal balance of different types of financing in everybody's capital stack, and that revenue-based financing is not a substitute for permanent capital. So revenue-based financing is not going to cover, months and months of operating losses. Like, you're just gradually eroding your working capital base as long as the business is losing money. So the way that we often think about that is sort of, for X amount of equity, a business can afford Y. And so in a lot of cases, the right way to think about this is, look, I need for every extra dollar of equity I raise, I can get, some incremental working capital from these other sources of debt, but it's usually not sort of an all or nothing kind of proposition.
Next slide, there's a lot of numbers on this, so I'm going to go through it super quickly, but what I highlighted in red what I wanted to sort of focus on, which is sort of have a good example of a cap table with a good exit and a bad one. And this one is a company that is capital efficient, only had to raise $9 million of preferred equity, so they didn't have to raise this Series C, and they exited, had a good exit. And if you look down at the bottom right, everyone got a good return and was able to get a good sort of multiple and return on their capital. Whereas if you take a company that does have to raise a Series C, raises a $40 million Series C, or sorry, $4 million Series C. So they have $20 million of preferred equity ahead of them on the cap table. They don't have as good an exit. And then, pretty much nobody's making money on that deal. So again, when you think about that concept of sort of preferred overhang, and you're looking at your capital stack, and every time you take on new money and take on a new round of money, you have to think about sort of what exit you would need for everybody to be happy. And sort of every time you take on a new tranche, it's sort of adding to that stack. And so that's where I'm definitely seeing a shift over the last 3 months for people thinking of, okay, let's try and be more efficient with my capital, not have to raise as much. So I can have a $25 to $50 million exit and actually everyone be happy with that, as opposed to needing $100, $200 million exit for everybody to be happy. This, I like this graph. It's super simple, but it just sort of shows sort of visually what the trade-off is that companies are going to make and have to think about, and sort of the pillars here of growth rate, profitability, run rate, and headroom. In this example here, this is a company that has a lower growth rate and is really focused on profitability. So their run rate is not, it's sort of mid-level run rate. It's not super high, but the headroom is high. So there's a lot of future potential and room for growth. So somebody coming in, an acquirer, is going to have an opportunity here to really, do future growth, whether it's through distribution channels or new product launches, like I said. But it's a spectrum, and it's not an all or nothing. And certainly, realize when I'm talking to these clients that it's not, like I said, it's not black or white. You can't not grow at all. You have to have some level of growth generally. It's just a question of finding that right balance and sort of where you want to be on that curve.
Yeah, and Anthony, sorry, I was going to jump in on that really quick too. I agree. That's well said. I think if you're the leader in your market, it's easy just to say cut costs and wait it out. But for everyone else, they have to keep growing, have to keep for tech heavy companies, they have to keep iterating, at least to kind of keep customers happy. Maybe you shelve things that are kind of nice to have upgrades, in favor of those. And, and then in terms of, you don't want to cut off your marketing spending entirely, but maybe, you can cut that budget most effectively by kind of, as you've pointed out numerous times here, by focusing on your most efficient channels, the biggest returns, even if overall growth might not be quite what it was if you were spending on all of your different marketing channels, but you'll kind of strike that balance well.
Yeah, you're stealing a little of my thunder. My last slide, I'll talk about marketing.
Sorry.
No. I think that's good segue. Two more slides. One slide. So this is, I pulled a data set. It's super small. It's only like 10 of my clients that are direct to consumer. But even in this small data set, you could see the trend because I said, this is the theoretical trade-off, but do I see this in practice? So I went and I pulled on the x-axis, it's the growth rate, Q1 2020 over Q1 2019. On the y-axis is contribution margin, which is basically gross margin minus ad spend. And you can see even in this small data set that there is a clear trade-off between growth and profitability. You have a couple of outliers of companies that were probably really well capitalized and raised big rounds and decided they had to grow massively, but they did it at a cost of negative contribution margin. In this one case, over a negative 200% contribution margin. But even when you get there's a cluster here that tried to grow 100 to 200% that had 0% contribution margin, and then you have a few here that had slightly lower growth rate but have positive contribution margin. So for most companies, this is sort of showing in real life that you are going to have this trade-off, and it's figuring out where you want to be along this scale, and it will depend on how much capital you have, how much cash you have in the bank today, what is your cash runway, what is your ability to raise future capital, right? The more ability you have to raise future capital, you can sort of grow faster and afford to be unprofitable. But if you don't have that ability and you already have a bunch of preferred capital sitting on your cap table, you have to lean more towards the profitability aspect. And then lastly, obviously thinking about your exit strategy and timing. And if you're looking to exit soon, maybe you want to focus more on growth and just getting that top line as high as you possibly can right before exit. But if you're talking about exiting in 3 years' time, you maybe focus more on sort of how do I get there, like I say, with raising as little capital as possible. So just wanted to share this, even though I know it's a small data set, but it's thought it was interesting. And then last slide is sort of operationally, what am I talking to some of my folks and clients, and what are they doing to preserve cash and conserve cash? I think even the folks that are more on the growth spectrum and have the capital, even those folks are still looking at cash. I mean, I have clients that have $10-15 million in the bank, so can afford to burn a little bit, but even those guys are putting in place a bunch of actions today to minimize cash burn and extend the runway as much as they're possible. So one thing is definitely this sort of COVID and environment has forced people to take action quicker. So decisions being made super quickly, communicating with everyone and communicating often and openly with your sort of, not just your employees and your customers and your suppliers. Looking at cash flow, this is one thing I'm doing a lot more of, rather than just looking at your financials on a monthly basis, sort of the traditional old fashioned way. People are really looking at it on a more frequent basis, weekly, or, for companies in crisis, even daily. But at a minimum, I'm doing weekly sort of cash reviews with a bunch of my clients and sort of looking at where they stand and reforecasting and sort of doing scenarios based on that. And then I think there's ways to get a little bit more creative in terms of extending runway. I think negotiating with suppliers, I've found over the last 2 months, most of my clients have found, their suppliers have been, for the most part, pretty accommodating and extended terms, but some of them are trying to get creative rather than just, for example, ask for an extra 30 days or 60 days. I've got one client that got stuck with $2 million of inventory, right? Because they bought a bunch of inventory before COVID and then it hit, they couldn't sell it. But the supplier doesn't want them to go out of business either, because then they're stuck with a bunch of inventory they don't want. So they negotiate a terms where it's a percentage of sales. So they're basically paying 10% of sales every week to the supplier. So it's sort of a win-win. If the company does well and performs better, the supplier gets paid off quicker. If the company doesn't, then it's a slower payoff. But I think being creative, as I said before, focusing on your high margin distribution channels, your high margin SKUs, and there's that point about refining marketing budgets. I think, especially in the direct consumer world, this is, people were spending tens, hundreds of thousands of dollars, not just on paid advertising, but on influencers and PR and agencies and all of that stuff. And, when COVID hit in mid-March, everyone slashed and burned that. And they found that it hasn't, in a lot of cases, hasn't made as huge an impact as they thought. And it remains to be seen whether that, again, is just a COVID bump from April and May, or whether they can sort of get away with continuing to keep that spend low. But everyone has looked at their marketing sort of budgets and their messaging and thought about how they had to tweak that, as a result. And my very last point is sort of goes back to that question that the participant asked about sort of exploring alternative financing options. So whether that's government relief, different kinds of loans, definitely that's something to look at to sort of extend runway. So there's a lot that can be done, and I think, again, this is sort of the new norm. I don't expect any of this to change in the near future. I think this sort of focus on cash is gonna be around for a while.
Anthony, I think one thing to add to that too, and this is maybe more B2B related, but thinking about how customer mindset will likely have changed in a kind of a crisis type environment, I think is critical in being creative around that. For example, where cold calling on new customers is in this March and April of this year for sure would have been a complete waste of time, and you might even put people off. But maybe you call existing customers and kind of lead with the what can we do to make your life better kind of approach, and maybe you get upsells out of that. The other thing that's interesting is one of our software companies that sells into the airline industry, they've actually found that giving people kind of a goodwill, on a multi-year contract, giving people kind of a goodwill discount at the beginning is actually an incredible strategy right now. Whereas, in a non-crisis environment, if you tried to discount the beginning of a contract, it might look like you're sort of desperate to try and sell. Whereas, in a crisis, you look like you're kind of doing the right thing. So yeah, I mean, again, just trying to think about the position that the customer is in and be creative around how to use that.
Yeah. I think creativity and, like I say, open communication is sort of a critical in these times.
Andy, taking the other side of it, any sort of common mistakes? I mean, it's probably the other side of what you're saying here, but have you any observations from the team in regards to when you see sort of mistakes made through blocking and tackling in these sort of circumstances that are avoidable? What do you generally see? It's probably overlapping a lot of the points you made: lack of communication, lack of meetings. But any key things that you guys have seen?
I think it's just not acting quick enough. I think it's people who sort of, if you're waiting and seeing. I think one of the things I sort of advice I gave back in mid-March and end of March when this happened is better to take action quicker and then sort of course correct yourself than do nothing. I think because there's so much uncertainty, you can have a tendency to sort of wait and see what happens. But I think it's better to take action, whether that's on, taking the tough decision on payroll and cutting payroll, and then you can always hire people back and increase their cost, increase their salaries. I think that's something critical to sort of do. And
the only other comment I was going to make before the rest of the group or anyone that's listening is we've seen, I couldn't agree with you more with point number four here on negotiating better terms. We've had a few of our companies, listen, call it the COVID excuse or just call it the reality. Yeah. If there's a point in time where everyone has the ability to renegotiate in fairness and kind of understanding, it was definitely a couple of months ago. We're still kind of in that point, but tens of thousands of dollars saved from the most obvious kind of rent, over the top rentals to the service provider. So I think that's an excellent point, and hopefully some of the folks on the call have considered those.
Yeah, I mean, I had clients that literally just went to their suppliers and asked for the COVID discount. I mean, they were sort of very blunt about it and found that most suppliers were willing. Now, again, it's not going to last forever. People are going to probably start coming out of that and trying to increase again, but people are pretty accommodating because they want long-term customers, and they want sort of a win-win for everyone.
And to your point, Anthony, the earlier you act in trying to get those discounts, the higher likelihood of success, right?
Mm-hmm. Yeah.
Okay. We're gonna kind of open it up. I did get Anthony one message from Joanna, who I think had to jump slightly earlier in regards to the slides.
Yeah.
And given those that are registered and the emails we have, if we'll distribute some of the content, but maybe we don't want to answer that in fear of anyone dropping earlier than they should.
Yeah. Yeah, I'm sure we'll send a follow-up with all of our sort of contact details, and happy to have sort of individual, obviously, follow-up conversations with folks.
Great. So this is, I think that's a great introduction and setting the stage through these materials. And for the group here, absolutely welcome questions. Some of the opportunity to ask some questions on anything that was not discussed, or you want some further points. Okay, Joe, can you unmute Morgan, if that's possible?
Cool. Can you guys hear me?
Yes.
Yeah. Awesome. First of all, thanks a lot, everyone, for putting this on. It's really helpful. I'm kind of thinking about, you're seeing companies of all sizes, big and small, old and new, thinking about short-term budgets versus long-term budgets. Big companies are withdrawing guidance. I think smaller companies and growth companies are thinking about budgets, through COVID, and then a return to sort of that long-term, to your point on previous strategy, it may no longer work, that return to kind of long-term budgeting and forecasting. How are you guys kind of thinking about that transition, like the inflection point where you see that making sense, and just kind of any puts and takes that would be helpful to think about when doing
it's tough with it. I guess the timing is the question that everyone asks. And when I was doing the reforecasting, like, I mean, every month it just it becomes clear that this is like longer and longer term, right? And when we all went into this, and we thought it was like 2 weeks of lockdown, 1 month of lockdown, and now it's 3.5 months later, and everyone's still locked down, and it's at least 3 more months and 6 more months, and who knows, right? So, I think I've got most of my clients now are sort of assuming that this is going to last until some sort of the end of the year. There'll be the rest of this year is sort of depending on the industry that they're in and what they're selling exactly, but at least until the end of the year, and then we're sort of focused on 2020 and and where we're going to be at the end of 2020, and then in 2021 we're sort of hoping that coming into Q1 that it's going to be back in the norm, but that's sort of assuming that there's not a second massive wave, obviously, in the winter, and if that happens, that sort of throws everything in the water and sort of have to redo this. But that's sort of how I'm thinking about it. Is sort of 2021 is sort of gradually back to normal starting in Q1. But again, I think it's super industry specific because you have direct to consumer brands that in November, December are going to hope to have record months because again, everyone's at home and everyone's going to be online shopping. So if you're direct to consumer, that could be really uptick sooner. But if you're B2B, because offices are not going to open until later in the year, next year, never, who knows? It's tougher to forecast. So I think to that, and what we're doing is really, I think I mentioned here in this third point is just evaluating different scenarios. And I think it's really understanding what is your base case, but what's a scenario? What does your cash look like in a scenario where revenue is 50% lower or 20% lower? Is super important. And when you're thinking about raising money, the clients that are raising money now, like I say, they want to have enough to get through 12 to 18 months. So it's what's enough to get through 12 to 18 months in a downside scenario, not just your base case scenario.
Yeah, and I think Anthony, further to that, having a plan at each of those stages as well, I think is important, right? Like it's one thing to think about where you want to kind of cut back and where you want to focus, what capital you are spending today, but it's also good, I think, to plan those other scenarios as well, so that you're not kind of scrambling if one of them materializes, right?
Mm-hmm.
Great.
Cool.
Thanks, Morgan. Any follow-up to that, or you good?
No, that's really helpful. Thanks a lot, guys.
Cool. Hey, Matt, Anthony, can you both share your thoughts and guidance around sort of the balance of growth, which obviously venture is generally looking for, and that's kind of how it's been advertised, versus profitability. How do you guys think about the relevance of those two things, both run rate of growth and profitability?
Anthony, you want to go first?
Sure. I mean, I think it really depends on the stage that the company's in, how much cash they have in the bank today, and how, as I sort of mentioned on the other side, what is their ability, both desire and ability to raise future capital. You may have a desire to raise it, but it may be very tough because of, for whatever reason. And that's going to really drive a lot of where you fall in that growth versus profitability lens. I think for the vast majority of my clients, they still, as I said, want to grow, but rather than growing 100% or 200% next year, they're fine growing 50%, which is at the end of the day is actually still amazing growth. I mean, if they can get 30%, 40% growth and be break even, that's a win. That I'm happy with that forecast. I think most of my clients are happy with that. If they can realistically think that next year they'll be, grow 30, 40, 50% and be break even. So that's sort of, again, balancing growth versus profitability. But on the profitability side, you're really looking at your efficient spend. So both efficient ad spend, marketing dollars that you're spending. Again, payroll, people have, even if they didn't cut salaries, they've certainly frozen hiring, and they're just being more efficient. Teams of 5 that thought they were going to grow to 10 are like, actually, I can do this with 5 or 6 people. I don't need 10 people. And so they're trying to be more profitable. And on the growth side, focusing on, really efficient ad spend dollars. So they're still able to grow, but just at at a slightly lower rate.
Yeah, I agree with that, Anthony. It's really, I mean, that question is really stage dependent, because the earlier the company, the less kind of traction that the company has, the more that the risk of not growing becomes almost as dangerous as the risk of running out of money, right? I think something important to do is to kind of model what the company looks like in 6 months, 12 months, if you're targeting profitability. And in a lot of cases, the cuts will have to, for earlier stage companies, the cuts may have to be so drastic that you're not doing product maintenance that you should be doing. You're losing brand awareness. All of these, there's a bunch of risks to that. So again, as you said, Anthony, you don't have to, it's not sort of growth at all costs by any means, but you don't necessarily want to sacrifice too much just to be able to say that you're at profitability as well. It's really just about understanding you have to continue to deploy capital in some areas, but trying to be as as you said, as efficient and smart and creative with resources.
To try to get to those economies of scale and figure out where does your break even point, and when do you get to that point where you have the economies of scale to cover your fixed cost. And
right. No, and sometimes your best path to that is growth, right? So listen, it's hard. I mean, it makes for a really hard balance, for earlier stage companies to try and strike, but you do have to kind of seek that middle ground.
So guys, I have a couple questions that have come in, which is great. So keep them coming if you want to DM them over or to the group. So this is from Erica Ho. So she's saying they've been running countless scenarios since this all happened. There are so many unknowns. How many numbers of scenarios would cover the majority of bases?
Anthony, I'm just going to go on mute and let you handle that yourself.
Oh, God. I would say like 20 scenarios. No. I honestly, I'm sort of old fashioned. I try to just do 3. I mean, base case, upside, downside. And in terms of like real scenarios, I think like just logistically, you can't have like 10 Excel models that you're trying to manage. But that being said, I mean, if you built the model in a flexible way, you can sort of play with I sort of distinguish between scenarios and sensitivities. Scenarios is like, here's like real scenarios that are sort of longer term, upside, downside, base case. And then sensitivities is understanding, okay, for every $1 increase in CPA, this is my cash impact, or every 1% of gross margin, this is my cash impact. And if you built the model, so that it's flexible, you can just plug in a number, say ad spend or CPA goes up by 10%, and just see what it does in the model. I wouldn't call that a scenario. I would call that just understanding what your sensitivities are, so that you can track your marketing people every day, every week, looking at their efficiencies and knowing what their targets are that they have to hit. That's how I answer that, Matt.
Yeah, I know, Anthony. I fully agree. The sensitivity is that's a better way to do it, because it's kind of a real time look at where you're headed that you can, that's very easy to adjust to as you get more data as you go along, as opposed to, the problem with the scenario analyses is just that they're static, right? And you have to kind of constantly redo them. Whereas, if you understand the sensitivities, you can, it's easier to kind of update that in real time. The other thing I would say too is, just you can almost think of when you're looking at the scenarios initially, think about what's your plan in those scenarios, right? Because and then you can kind of you can see to what degree your actual trajectory heads towards one of your 3 scenarios, and say, okay, what does that mean? Which planned path does that put me on? And plan in terms of hiring and ad spend, and how much runway you want to maintain, if things end up better than you thought they were going to, where do you want to spend that extra capital that you now have? The more you kind of plan that out in advance, the better you're going to be able to react, when you get to one of those paths.
Yeah, I've got, models where people want to do hiring, but so they have it in the model, but it's sort of almost a placeholder, and it's either dependent on hitting growth targets or fundraising or whatnot, and they know that they're not going to hire this person until they hit those, but I have it in the model as sort of a placeholder, and then you can just sort of flex it. So
yeah.
Another question here, a good one from Patrick. I guess all depend on what kind of business you're in. Curious, given COVID in the U.S., the current situation in the U.S., which obviously isn't great, should there be a focus on international markets, which is doing better in regard to COVID?
I mean, if I can answer from my industry of like direct consumer, I would say probably no, because it's tough. I mean, it's tough to set that up, and if you're a direct consumer brand that has your operations in the U.S. and your warehouse in the U.S. and that's where everything is, then it's tough. It's certainly expensive to set up sort of facilities, and you got to build a website. So it can be tough. That being said, there are some countries like, Canada. I mean, a lot of my clients will ship to Canada or even Australia, which is pretty much rid of COVID. So to the extent that those countries you're able to just set up so that you can distribute fairly, from the network that you already have set up, it's something that you could consider. But anything like that, it usually is capital intensive and also time intensive. So setting that up is going to take time and effort of management. And it's just where, do you have the bandwidth to do that? And is that one of
and Anthony,
priorities?
I would add to that too. How long, I mean, you have to have a pretty good view on how long you expect that current situation to persist, right? Because to your point about it taking a lot of time to set up, it could be that by the time you've actually got that thing up and running, everything is back to normal in the US, or maybe that country's gone,
exactly.
into a second wave or whatever, right? It's just, it's something you don't necessarily want to make a big short-term
no, unless it's a longer term play for you and you think that it's the right move in the long term, then
right.
Yeah, I think that's.
And people massively underestimate the amount of capital and time that it takes to support international. I mean, I've seen this so consistently over the years. In order to have a successful business, you've got to have boots on the ground. You've got to have marketing support, like understanding the nuances of that in an international market either costs you a ton of margin points, which you would have to give up to a distributor or a retail partner who's going to take all the risk and handle that for you. Certainly in direct to consumer, there's reverse logistics, there's offshore inventory storage, which you have to carry on your balance sheet. It's just a ton of risk, and it almost never goes according to plan. So the marginal profitability of every incremental dollar that comes from international, instead of US, where you can support it using all the resources and the partners that you already have, just be careful.
Right. Couple other ones that have come in. We'll do. So basically, the question is, Matt, I'll have you kick off this one. Thinking about a company that was in the fundraising process, maybe some good traction, some good conversations in motion. COVID hit. How should a startup think about, in the eyes of a VC, and valuation or depreciation valuation as relates to pre and post COVID?
Yeah, no, it's a good question. So much of, especially early stage, so much of the valuation, formula is relatively arbitrary, I think, with a lot of VCs anyway, that and listen, I mean, venture capitalists are capital C capitalists, right? Their ultimate goal is to drive the best returns for shareholders. If they think they can take advantage of a situation and take advantage of lower valuations because of a market disruption, they're going to try to push for it. other than the usual thing that you do, which is, get competition in there to try and, play people off each other. But if that's not an option, I don't think there's any way to persuade a VC, to give you a higher valuation, even with the most sort of thought out and metrics driven kind of argument for that. If they know they're the only game, they're the only player, in a round that you need to raise, there's not much you can do about that. So the one thing you can do is either, if you do have the ability to say, okay, thanks, I'll pass and wait a few months, then great. That's not a bad option. If you don't, if you do need some round of fundraising, I think we hit on this slightly earlier. Maybe think about it more of, if you were in the market for a Series A, you maybe say, okay, instead of that, I'll do a more of a bridge round, and I'll cut the dollar amount in half or by a third or whatever, and and extend runway out another 6 to 12 months, and when the market rights itself, I'll go back for that bigger raise with better valuations.
I would just add to that. I think for any of the founders, I think first of all, it'd be easy to say for anyone that wants to beat you up given COVID, it may not be the best partner, right? That's kind of one potential answer.
For sure.
And the other one, there's always some form of capital depending on the business and the opportunity. So where there may be someone that's trying to beat you down and take advantage, ask yourself if that's someone you want to work with. And number two, there's got to be alternative source of capital. But ideally, if you have the ability to hole up, get creative, using some of the functions that Anthony kind of called out here, it's probably better to come out in the market where it's more ripe. I would say now the difference between March and April to going into July tomorrow is night and day. There's plenty of money, there's plenty of cash, there's a lot of activity. So don't be discouraged given how painful it was in the earlier part of this pandemic. There's plenty of venture capital and there's plenty of angels out there that want to invest.
And go out to a lot of people. I mean, competition will always, that's always your best route to getting your valuation up.
I know we're coming up on time. I want to be mindful. We have still the majority of people here, so thank you so much for staying with us and listening. One quick question, Anthony, Chris, Matt, whoever wants to take it. I think it's an interesting one. Is there with COVID and quarantine, is there a difference as relates to speed and getting deals done? Prior summers, people are in Europe or cocktailing on the beach or sort of taking vacation. Is this summer a different summer as it pertains to getting VCs active and participating given quarantine?
It's a good question. This is definitely not a normal summer.
No, I've definitely heard people say that it will be quicker. I've had at least one, I think two that have said that are expecting to close deals quicker. I got one series client that got a term sheet for a Series B that had 15 days to close. And not because it needed to close quick, but the VC they just wanted to move quick. And like I said, I think people's vacations times are totally different. So I think it will be, but because people are just working more. They're always in front of their computer. It's tough to shut down and turn off the way that people did in the past. But
yeah, and I would add to that too that you also have a couple months at least, if not three or four, where funding levels, venture funds have they have a lot of capital to deploy, and you had a really slow funding environment for several months. So there's going to be pent up capital looking for a home. I mean, don't ever forget, founders, that every venture fund has an investment period, and they need to they have to give back their capital if they don't invest it during the investment period. So if they've taken 3 or 4 months pause, they're going to need to catch up at some point. So
okay, I'm gonna kind of leave it to Anthony and Chris for if you choose any kind of final comments or words. I want to again thank everyone for joining. We also have somebody in from Amsterdam. His name's Joe, who's facilitated all this. So he's up a little bit past his bedtime. So Joe, thank you. And just from a C2V perspective, just acknowledge the the great work that Propeller is doing in the space. And if you haven't worked with them or talked to them, you should. We'll huddle up with them in regards to circulating more information and making this kind of bite-sizable or the full deck. But Anthony, Chris, any closing words?
No, I think we covered it. It's great to be here and happy to present to everyone. And I think it's been a roller coaster the last 3 or 4 months, and I think it's going to continue for quite some time. So I think this sort of shift is here to stay, and I think it's something companies are going to have to focus on for the long term, is sort of the cash runway and profitability, and I think it's a permanent shift, I think.
Great.
Thanks for having us, Chris.
Great. And if there's any feedback that was positive or anything that we can improve upon, Chris at c2ventures.co, you can shoot me an email directly just so we can continue to do these things and hopefully do more with Propeller. Thanks for everyone for joining, and be well and happy summer.
Thanks, Chris.
Bye, guys.
Thanks.